We're staying in the financial services sector now. Proshare has released its report on Nigeria's banking industry with a focus on the case for refining Tier 1 banks. Well, First Bank is also one of those Tier 1 banks. So apparently, we're talking about First Bank and some other banks. The report, among other areas, highlights determinants of long-term profitability that will lead to the conversation of the impact of that profitability to the real sector and the economy. We have Abdul Kudus Isiaka, economist with Proshare, joining us for that conversation. Good morning, Abdul Kudus.
Good morning, Ini.
Yeah, I think the last time we had a conversation was on the MPC.
Yes.
It would be nice to know, the impact of that MPC and all that, but
yeah.
That's not the conversation for today.
Yeah.
So tell us about this, your report on Tier 1 banks. Why? What's the essence of it?
Okay, so the idea behind, you went over the title, right? So the case for redefining Tier 1 banks, and so we could take the discussion from that point. So the idea is we want to, reconsider why do we, refer to certain banks as Tier 1 and other banks as not Tier 1 or as Tier 2, as the case may be. So basically, we went over the special banking report published by AfriInvest, a Lagos-based investment company, which was published in 2013. And that 2013 report actually speaks to a number of requirements, namely assets, especially assets. Of course, it talks a bit about, some prudential guidelines like non-performing loans and capital adequacy ratio and liquidity ratio. But basically, it draws the line between Tier 1 and Tier 2 based on asset size. And it stipulated an asset threshold of 1 trillion in 2013. Upgraded that to 5 trillion in 2020. But the question from us, we tried to answer a number of questions, ask and answer a number of questions, right? But the question from us was that why assets alone? As you know, there is no shortage of performance ratios we could consider where we want to analyze or determine the performance and the ranking of banks. So we probably want to look at, bank lending capacity ratios like CAR, LDR, even the capital, the CRR ratio, cash reserve ratio. There are also ratios. You want to look at, again, non-performing loans. You want to look at the asset quality. You want to, again, look at, so there is no shortage of ratios. So we're trying to come up with a methodology, right? And we actually have done that. A methodology that is quite testable and that scientifically selects, weights, and sums the most important determinants, most important ratios that speak to long-term profitability for banks. And so that's what we've tried to do. And so we're also canvassing regular review. So fundamentally, we feel
regular?
Annually, at least. So we feel that...
So who'll be doing that review? Because that's a lot of work.
Well, that's what we do at Proshare, really. And that's why we came up with the Proshare Bank Strength Index, actually, the PBSI. And the PBSI is like a much more transparent basis of saying what bank is a Tier 1. So we're working with, the data, right, from all the banks that have their data, of course, their financial reports publicly available. And so we are going to assign scores, right? And banks that come up with scores in the 50th percentile are regarded as Tier 1. And those that don't are regarded as Tier 2. So just trying to make it as transparent as possible. I think another important observation, one important thing you could take away from this report is the fact that we're saying that, arbitrarily setting that 1 trillion or 5 trillion we need to, take a second look at it. We're also making a point that, periodically, we need to take a second look at it. Banks should therefore not be regarded as Tier 1. It's not a case of once and for all.
Once you're a Tier 1,
you are ever a Tier 1. It's not once you're a Tier 1, ever a Tier 1. It's not quite the case. We believe that, because, as I mentioned, there are a number of bases for which you want to, consider the performance of banks. So we need to regularly reassess that. Another important reason why it's necessary to do so is that, you see, the Tier 1 appellation is single most important determinant sometimes of what banks get the big ticket transactions, what banks are able to, get so much customer deposits, what banks are able to issue securities at, considerate or, lower yields. and what banks are able to fund big ticket transactions consequently. So if you take all of this together, there is a very, very important need for us to, look at it again. What is a tier 1 bank? And, take a second look at it.
Yeah, and a review of the status every year according to you. But, to a lot of people, especially those who are not very active in the financial services sector, who are listening to this conversation, they'll be like, okay, so whether it's a tier 1 bank, they have high profitability, what impacts do they make? I mean, the cost of funds now is so expensive. So whether you're a tier 1 bank or not, it doesn't seem. CRR has also been complained to be high. So that has also reduced what's available to. Even though recently the CBN has said that credit to the private sector has increased in the last 4 months. But in the midst of all that is happening in the country at this time and in the world, actually. Whether you're a tier 1 bank or you're a profit, or what difference are you making to the economy, especially to MSMEs?
Okay, so essentially, whether you're a tier 1 bank or not is something of concern to investors. So at the end of the day, whether we are, we want to lend, want to borrow from the bank or not, we could be invested in the bank, right? We could own shares in the bank. We could also buy their bonds and buy their CPs. Commercial papers, every now and again, they're issuing one security or the other that you want to invest in. And so I think it's at that point it becomes, crucial for you to know, oh, is this bank a tier 1 bank or a tier 2 bank? Because it determines a lot of things. It determines, most importantly, it speaks to the long-term profitability of the bank and what kind of returns you can expect from the bank. So again, I think at this point, I need to make a distinction. There's that usual, confusion or conflation, as the case may be, between what a systemically important bank is and what a tier 1 bank is. So whereas a systemically important bank is one that, in the eyes of the regulator, is too big to be allowed to fail, because it has very large deposits. And so, if there's a bank run, a lot of people get to lose their funds. But that's really not the concern of a typical investor. The concern of an investor is not so much of financial system stability. That's for the regulator. The concern of the investor is how much do I expect as returns? And so you want to know, is it a tier 1 bank? What assurances, what guarantees do I have that, there will be so much returns on my investment? So that's why we are taking a second look at it, and we're trying to, come up with something that is much more, as I mentioned, transparent.
So you're looking at it through the eyes of an investor.
Yeah.
So an investor, of course, will be interested to see how the bank, how sustainable his investments will be if I invest in this bank, the management, and the transparency of it, I believe. But what about for the person who is looking for funds?
Well, you want to imagine that if a bank is truly a tier 1 bank, relatively, you want to imagine that cost of funds in such a bank will be lower.
Is that the reality?
Not necessarily, but you want to imagine that to some extent, right? They have a much more robust credit risk management, and so they are not running that large risk, of illiquidity, as the case may be, unlike smaller banks. And so you want to imagine that they're able to lend easier, and more to the private sector. And the point you made about private sector lending rising is quite valid, and it's expected, as a matter of fact, because, when you begin to see economic recovery, right, you see credit expansion, unlike what happens where there is a recession, where there is a scale. Banks tend to scale back their lending because, of course, credit performance is problematic at those times.
But we mentioned MPC, which you're a part of the other time, and interest rates now, being higher. That's also could scale back.
Yeah, I agree with you. But again, I think we're looking at a balance, right? So one factor trumping another factor. But then again, it's valid observation that, the MPC, MPR, so the MPR higher by 150 basis points, going to kind of signal some negative sentiments, especially when you want to look at funding businesses through bank loans. You know, it's not likely to be as it used to be in the past, but then again, as the economy recovers from the recession, from 2020 recession, we'll see more lending. I mean, something similar played out.
I think we're on the path of recovery until the war in Ukraine.
Yeah, exactly. But I would still say in the case of Nigeria, we're still recovering, despite, you know, exiting 2021, which largely was supported by low base effect. We still recorded above 3% real GDP growth. So I would still say that we are still on the path of recovery, and maybe that's why we're seeing lending to the private sector. How long that would be sustained is something we'll have to wait and see. Really.
Before the impact of the war starts biting in.
Yeah.
I mean, we're already seeing aviation fuel, long queues at petrol station. All of this, I know, will feed into the figures that we'll see.
Yeah, certainly.
Growth figures, activity, manufacturing, you know, and all of that. I mean, most likely they should. So now that Proshare has this report and are proposing an annual review of Tier 1 banks, so what do you do with this report? What's the way forward?
Okay, so there are a number of takeaways from the report. First of all, we're introducing the Proshare Bank Strength Index, which is, as I mentioned, a more testable approach to determining what banks are Tier 1 and what banks are, you know, Tier 2. Firstly, that report, I mean, that model or that methodology highlights very important metrics that weren't considered previously. We're talking about governance. We're talking about governance metric, like you want to talk about board balance, which wasn't considered before now. We're also looking at, you know, a method through which we're summing, we're weighting, and that's based on data. I think it's important to mention that. So we're not just selecting arbitrarily, as we used to have it. We're selecting those particular variables that have proven over time, okay, to be, you know, determinants of long-term profitability. And maybe I should also say this, in subsequent editions or reviews of this, you know, model, we expect that some new variables will come up. For example, you know, it's a trend. The trend is that, you know, there's so much competition, especially in the retail banking end, right, because of the influx of payment service providers that are essentially non-bank financial institutions, right? And so the influx has made, you know, so much competition go on there, and we're seeing banks themselves also up their game in that regard. We're seeing them, you know, put up a fight, and they are increasing their digital earnings. So we're seeing digital income to, you know, as a ratio of gross earnings also increase for many of those banks, right? But as of now, it's not such a very critical determinant of long-term profitability. But we expect that going forward, right, we will see that become a much more critical factor.
Yeah, because I think digital bankers are giving them a run for their money now.
Yeah, the fintechs.
So, the fintechs. If traditional banks do not stand up, they might just get run over.
Yeah, so they're trying to actually put up a fight, although some of them are considering collaboration as a strategy. But at the end of the day, they're trying to protect their earnings, right? So, but at the end of the day, what's likely is that if they choose to collaborate with these PSBs, the likelihood is that they would just be kind of they'll be realigning and maybe diversifying their earnings, because what will happen is they're also earning from these clearing services that they offer to these PSBs. So PSBs are not deposit money banks at the end of the day, so they can't do without DMBs. So there still is going to be some form of collaboration between
more
them.
Like it, more than competition. Well, I would also like to ask that as you review, you know, the factors, also calculate their impacts. I think it's important. I mean, what are banks there for? What's their functionality? Apart from, you know, their profitability and their tiers and all that, they should also be impactful to the real sector. So I guess that should also be a component.
No, I can tell you that we actually took a look at that in this report, right? So we evaluated the loan books of many of these banks, right? And we considered to which sectors, we tried to answer the question, to which sectors are Nigerian banks lending, right? So we found that between 20 and 45% of most Nigerian banks' loan book is exposed to the oil and gas sector. Now, that's problematic for two reasons. Number one, we are seeing an energy transition, and we are seeing, the drive for, climate change. We're also seeing the oil and gas sector in Nigeria not do so well. It's maintained consistently. It's been, recording negative growth. And I mean, if you take all of that together, you're asking questions about the long-term sustainability of the earnings for such banks that are so largely exposed to, the oil and gas sector. So again, we also looked at manufacturing. Manufacturing was less than 20% in the case of most banks. That's also problematic because, what economy grows without being industrialized. Then we also try to make a case for what sectors going forward should be considering, banks should be considering to fund. Of course, infrastructure funding is a major one, but then again, there's been argument about whether banks, are in the position to fund public infrastructure, which, you would consider to not be so bankable. But then, the counter argument we made is that, there are several models that can be, adopted. There's the PPP model. There's also the, financialization model that can be adopted to ensure that, despite being a public infrastructure project, it can still be profitable to private concerns, banks. That is.
And I know the federal government has a lot of programs also trying to bring in the private sector into infrastructure funding and all that. Well, thank you so much for this expose into your report. We do look forward to it being impactful and making changes in the financial services sector. Thank you so much, Abdul Kudus Isiaka, economist with Proshare. Let's take a break now. After the break, AFEX Commodities Market is next. Do stay with us. This is Business Morning on Channels Television.